Have you ever heard the saying, "The early bird gets the worm"? It's a classic phrase that emphasizes the benefits of getting a head start. But did you know that this wisdom applies to investing as well? Well, in the world of investing, it's more like, the early investor gets the cash. Starting early can make a huge difference in your financial future. That's because of this amazing thing called compound interest. It's like magic. Compound interest means that you earn interest on your initial investment, and then you earn interest on the interest you've already earned. When you invest early, your money grows, and then the growth grows, and then that growth grows too. It's like planting a tree and watching it bear fruit year after year. This is called exponential growth, and it's how you build real wealth over time. The earlier you start, the more time your money has to grow and multiply. Think of it like this. If you invest just $100 today and it grows by an average of 8% a year, you'll have over $2,000 in 30 years. That's the power of compounding, and that's without adding another dime. Imagine if you continued to invest regularly. The results could be even more impressive. That's the power of starting early. The sooner you begin, the more you can take advantage of compound interest and the growth it brings. Time is your biggest asset when it comes to investing, so don't waste it. Every year you delay is a year of potential growth lost. The sooner you start, the more time your money has to grow. Even small amounts can turn into significant sums over the years. Even if you can only invest a small amount right now, do it. Every little bit helps, and it all adds up over time. It all adds up over time. Consistency is key, and the habit of investing regularly will pay off in the long run. Trust me, your future self will thank you. By starting early, you're setting yourself up for a financially secure future. So don't wait, start investing today. Okay, so you're ready to start investing, but there's one small problem: you're not 18 yet. You might think that being under 18 means you have to wait to start building your financial future, but that's not entirely true. There are ways to get started even before you hit that milestone birthday. Don't worry, there's a solution. You don't have to wait until you're an adult to begin your investment journey. In fact, starting early can give you a significant advantage. It's called a custodial account. This special type of account is designed specifically for minors, allowing you to start investing with the help of a parent or guardian. This type of account allows your parent or guardian to invest on your behalf until you reach the age of majority, usually 18 or 21, depending on where you live. This means they can buy stocks, bonds, mutual funds, and other investments for you. Think of it like a savings account with a turbocharger. Not only can you save money, but you can also grow it through smart investments. The earlier you start, the more time your money has to grow. Your parent or guardian opens the account for you, and they manage it until you're old enough to take control. They can teach you about investing along the way, so by the time you take over, you'll have a solid understanding of how it all works. You can even ask them to invest in your custodial account as a gift instead of buying you the latest video game or gadget. This way, you're not just getting a present, you're getting a head start on your financial future. Imagine the possibilities when you start investing early. Now that you have a custodial account, you might be wondering where to invest your hard-earned money. It's a big decision, and it's important to start on the right foot. You want to make sure your investments are safe, yet have the potential to grow over time. My recommendation: start with a low-cost S&P 500 index fund. This type of fund is a great way to get your feet wet in the world of investing, without taking on too much risk. What's that, you ask? An S&P 500 index fund is like a basket of stocks from 500 of the biggest companies in America. It's a simple and effective way to invest in the stock market. Think Apple, Amazon, Google, the big players. These are companies that you probably use every day and are familiar with. By investing in them, you're betting on their continued success. When you invest in an S&P 500 index fund, you're investing in a little piece of all of them. This means you get a slice of the profits from these major companies. This is a great option for beginners because it's diversified, meaning your money is spread across many different companies. Diversification is key to managing risk in your investment portfolio. This reduces your risk, because even if one company doesn't do well, the others can help balance things out. It's like having a safety net for your investments, giving you peace of mind as you start your financial journey. Investing is important, but you need money to invest first. As a teenager, you have more earning potential than you might initially think. Don't be afraid to get creative and find new ways to make some extra cash. Think about your skills and interests. Can you mow lawns? Can you babysit? Can you walk dogs? Can you tutor younger students in subjects they struggle with? These are classic side hustles for a reason. They're in demand, and you can often set your own hours. If you're tech-savvy, maybe you can offer your services as a social media manager, website designer, or graphic designer.